Hello and welcome. Today we're jumping right in to demystify the language of business itself. We're talking about the core rules that every single company has to play by to keep its finances straight. It's a whole system called Generally Accepted Accounting Principles, or GAAP for short. So how do we make sense of it all? Let's find out.
I absolutely love this quote. It just frames accounting so perfectly. It's not about boring math, right? It's this incredibly powerful tool we invented to bring some order to the complete chaos of business. It's about taking something as wild and frantic as a company and getting it to just stand still for a second so we can actually understand what's going on.
And you can imagine, as businesses went from simple corner shops to massive global corporations, these three questions became impossible to ignore. How could you possibly compare two different companies, or even your own company's performance from one year to the next, if everybody was just making up their own rules? It'd be chaos. The only solution was to create a common rulebook that everyone agreed to use. And that rulebook? Well, that's GAAP. Now, to really see how these rules work in the real world, let's follow the story of a new entrepreneur. We'll call him Thabiso, and he's starting a business called Thabiso's Treats. This first batch of rules is all about making sure the game is set up correctly, right from the very beginning. Okay, so Thabiso kicks things off by investing $200,000 of his own money to get the business started. But almost right away, he hits a classic snack. His daughter's birthday party's coming up, and of course, he needs ice cream. So he takes $10,000 worth of product from his own company. So what is that? Is that a business cost, a personal thing? How in the world do you record that?
The answer lies in our very first rule, and this one is fundamental: the business entity principle. You have to understand this. For accounting, the business is its own separate person. Thabiso's Treats is not Thabiso. The company's money is not his personal piggy bank, and his personal finances must be kept totally, completely separate from the business's books.
So here's how that actually looks in practice. That R$200,000 he put in, that's called capital. It's an investment into the business entity. And the R$10,000 of ice cream he took out for the party, that's called drawings. It's a withdrawal by the owner. And here's the key. It is not a business expense. It has zero effect on the company's profit.
All right, on to the next puzzle. Thabiso buys a computer for $15,000 to manage his orders and paperwork. It's a pretty big cost for a new business. So the question is, does he record that entire $15,000 as an expense for this month?
If he did, it would probably make his brand new business look like it's losing money right out of the gate. And that doesn't feel right, does it? Because that computer is going to be helping him for years.
And this is where the going concern principle steps in. See, accounting makes this really basic, optimistic assumption. We assume the business is not going to shut down next week. We act as if it's going to continue operating for the foreseeable future. It's a simple idea, but it totally changes how we think about big, long-term purchases. And that one assumption makes a world of difference. If the business was closing down, you would have to write off the full R$15,000 immediately. But because we assume it's a going concern, we get to spread that cost out over the computer's useful life. In this case, 3 years. That process is called depreciation, and it gives us a much more realistic picture of the company's performance over time. Okay, but this idea of value gets even more interesting with other kinds of assets. Let's say Thabiso buys a plot of land where he hopes to build a factory one day. He pays $500,000 for it. A year goes by, the property market gets hot, and a new valuation says the land is worth $550,000. So which number goes on the official books, the price he paid, or the shiny new value?
And the answer comes from the historical cost principle. This rule is super clear. Assets are recorded at the price you actually paid for them. Period. Why? Well, because that original price is objective. It's verifiable. You have a receipt, a contract. Market values, on the other hand, can be totally subjective, and they bounce around all the time. Accounting wants facts, not opinions. So the answer is, you guessed it, $500,000. The books have to reflect that objective historical cost. This prevents companies from just, making up numbers and inflating their own value whenever the market feels good. It keeps things grounded in reality. All right, so we've got the business set up on a solid foundation. Now we can move into the fun part, the day-to-day action. This next section is all about the rules that tell us how to track sales and costs as they're actually happening.
So let's follow a typical sale for Tabiso's Treats. A big customer, Easy Supermarkets, places an order. On June 5th, the order is confirmed. By the 20th, all the ice cream is made and ready to go. On June 22nd, it's actually delivered to the customer along with an invoice. And finally, on the 30th, the customer says, "Yep, we'll pay you soon."
So, here it is, the big question. At what exact point in this whole timeline did Tabiso's Treats actually earn that money? Was it when the order was confirmed, when the ice cream was sitting in the freezer, when it was delivered, or do you have to wait until you have the cold, hard cash in your hand?
The answer, the only right answer in accounting, is June 22nd. And why that date? Because that's the moment the business fulfilled its end of the bargain. The goods were delivered, the service was rendered. Tabiso's Treats now has a legal right to that money, even if it's not in the bank account yet. The economic event has happened.
And this brings us to what might just be the single most important idea in all of modern accounting, the accrual principle. It says that we record transactions when they happen, when revenue is earned or an expense is created, and we completely ignore when the cash actually changes hands. It's all about the timing of the event, not the timing of the payment.
And right on the heels of the accrual principle comes its logical partner, the matching principle. And this one is just common sense, really. It says that if you want to get a true picture of your profit for a certain period, say the month of June, you have to match the revenues you made in June with all the specific expenses you had to generate those exact revenues.
Let's look at a super simple breakdown of June's profit. We've got the R$70,000 in revenue from that big sale. Okay, easy enough. We then match it with the cost of the ice cream itself. But look at the salaries. Even if Tabiso pays his employees on July 1st, their work was done in June to help make that sale happen. So that salary expense must be recorded in June. That right there is the matching principle in action. It's beautiful.
So up to this point, you might be thinking accounting is just this super rigid black and white set of rules. But in this final section, we're going to pull back the curtain a little bit and see that it's also very much an art. There are gray areas where accountants have to use their professional judgment. Just think about these real-world problems. What do you do about a customer who might go bankrupt and never pay you? You have to make an estimate. Or what if your company is being sued and you might lose? Another estimate. What about a cheap R$200 office chair? Technically, it'll last for years, but is it really worth the time and effort to track its depreciation? Probably not. This is where concepts like prudence, materiality, and consistency come in to guide those judgment calls. And this is where you can really see that wiggle room. Let's go back to that computer. There isn't just one way to depreciate it. A company could choose a conservative method that makes profits look lower in the early years. Or it could pick a more aggressive method that makes profits look higher and more stable. And guess what? Both are totally fine under GAAP. The only absolute rule is consistency. Once you pick a method, you have to stick with it. And this brings us to such a critical point. When you pick up a company's financial report, it's so easy to assume that every single number is precise, down to the last penny. But that's just not true. As this quote from our source material points out, sure, the cash in the bank is an exact number, but almost every other figure on there, from the value of a factory to the expected profit, has some element of professional judgment or estimation baked right into it.
And so that leaves us with this final, really important question to chew on. If the rules of accounting provide a solid structure but also allow for this wiggle room, this element of judgment, then how much of a company's financial report is hard fact and how much is it a carefully told tale? Are we looking at a perfect photograph of reality or a beautifully painted portrait? It's something to think about the next time you look at a set of financials. Thanks for joining me for this explainer.